What's up, everybody? Geoff Beers here from 40 Finance. Happy Friday. As I'm getting my camera stuff set up, I'm getting better at this every week. Thanks to everybody who has joined the live streams in the past. Hopefully that this one goes even better. Today, I posted a few topics on the board. One is the concept of potentially selling high at this market. The other one that I'll get into is real estate stocks as a segment that is kind of underperforming. And then lastly, as always, we'll do the Q&A portion. I see David Glantz has already submitted a question, which I will get to. But I wanted to talk about selling high for a second. And in that game, I think, I've seen some YouTubers talk about it this week, and I just think we're getting close to that. I was personally encouraged last week, and I'm bringing up the Yahoo Finance screen here. I was personally encouraged yesterday when we got to see a little bit of a dip. And I was kind of hoping that that would continue in through today so that we could jump on some deals and add to our portfolios. However, as we look at the real time of S&P 500 here at 1 p.m. Eastern time, it's went down a little bit, but it's still 0.79% positive. Not that that's a huge jump, but quite frankly, yesterday's minus 6% or minus 5% felt really good to me. And then there was a few things that I was looking at that one in particular is Visa that went under 190 yesterday, and I was getting ready to buy, but I had a couple other positions that I wanted to add to. So long story short, I've said this for a few weeks now. Like, I'm interested in buying right now. I'm not buying at where most of these prices sit. And that's just my 2 cents. So if I take a look at Visa from a buying standpoint, right? And we go the last month or so, the last dip was May 14th at 173.98. We went all the way up to 201. Now it's down to, it says 189, but the real ticker says 190. Maybe we'll see a drop in the afternoon. I'll try to pick it up 189 or so. But the bottom line is, it just doesn't feel like a great deal. You had a 52-week high before COVID of $210. We know about unemployment, right? We know that folks are going to have some trouble paying their bills. And even though Visa is not a holder of consumer credit, they do rely on purchasing to make their money. So I would say their short-term outlook is mixed at best. And I would like to take advantage of a better discount than is being offered today. So with that, I've had to turn my attention to think about, should I take some profits, even though I'm a long-term investor? And I did so actually today, which I'll show you here. This ETF, which I had 67 shares of, I think it was about roughly $5,000. I sold this. This is ARC Next Gen Internet. And there's 2 reasons I sold it. One is I was up plus 50%. So I think my investment level was about $50 a share. It has went up even more since the dip. And it's now up to $76. I think I sold at 78 or 79 today. And so I put 3,000 in. I made the valuation was right about 5,000. So I went ahead and took it. When I originally invested in this ETF, it was because it was this internet ETF, right? It was supposed to be companies that make most of their money through the internet, and it had it had like Square in it and stuff. But what it's really turned into lately is the Square and Tesla show. So you see Tesla, I hope you guys can see it. Tesla got added to this in the start of the year, and the percentage of assets of Tesla in this ETF, because it's managed, that doesn't follow necessarily a guideline, went all the way up to 10.84. Square's up to 7.9. And it just doesn't feel like it's the same internet focus. Roku's in there. It just feels different than the what I bought it for back in the day. So I was up big. I'm not a monster fan of Tesla. Kudos to Tesla and Tesla holders. You're about to hit $1,000 stock price or something like that. But ARK changed for me. I had the opportunity to get $2,000 out of it and lock it in. I think the markets are high, so I did that, and I'm going to be redistributing that, I believe, to QQQ. I'm going to wait for QQQ to go down, and the balance of the ETF side of my stock portfolio going forward for the foreseeable future will be a combination of QQQ, FDN, and IYC. So those are the three ETFs. Those will be my hold forever, kind of like the fundamental elements of my portfolio, and then I'll be accented with individual stocks, which I'll share with you as time goes on. So think about it in your own world. Is there something that you're up 50% on or more, and the stock market is, I would say, unreasonably high? Quite honestly, I would say unreasonably high right now. Is there anything that you have that isn't necessarily something you're going to hold forever? Should you just take the money and run? And knowing that if there is a dip, you can get back in it for cheaper. Something to think about. I did that cruise line video a couple of days ago, sort of admitting defeat on the cruise lines, which, dude, I totally was, I got hammered on that one compared to my sort of fundamentally solid picks. And I admitted it, and it's all good. But if I was in cruises and I made money in cruises right now, if I was up 50, 60, 100%, I'd be so out. I would have sold and walked away. Turn my phone off here. So anyway, that's my 2 cents. And sell high if you can. Look at a couple questions, and I'm going to talk about real estate stocks. David says, I know you like DraftKings. What do you think about esports, entertainment, and gamble? Let's take a look at those. Try to bring this. So esports is interesting. Oh, it's all the same. It's gamble. I don't know a ton about esports outside of the headline level. Hey, GG. Yankees rain, Lion 95. What's up, guys? But, I think esports at its core is definitely growing. How much money is in it from today is the hard thing for me to understand. I'm looking at this entertainment group, and off to the side here, let's switch to quarterly. So these growing negative earnings is not a super bright sign, excuse me. No P ratio yet. On the same token, it's a $5 stock. So is there any fundamentals we can read? Not really. This is a hard one to judge. So I think you have to trust your gut on this. You've got $4 million in debt. They've got $10K in the bank. I would just trust your gut. If you're into esports and you think it can do something, fine. Otherwise, with this one, I would be inclined to pass, only because I can't see anything, any fundamentals of the company. All right. Lions asking about the Stool Guy. That was funny. I think that might be on the homepage of Yahoo here. Yeah, this column. He's a better investor than Warren Buffett. Look, it's for entertainment. Dave Portnoy. I think it's funny, and I think good for him. And I think what he's doing actually is what a lot of people are doing at home. And I think that they're investing in risky companies. However, they're making money. If you're making money, then you're making money, and that's the bottom line. I wouldn't go so far as to ever say that I'm better than Warren Buffett, but if he's, from my understanding, he's like up like $500,000 or something since the pandemic. So, whatever, entertaining would be my word. So entertaining. All right. Oh crap! I got a knock. Hold on, guys. I got a knock at the door. Let me. I'm going to put up the front page of Yahoo Finance. Give me 2 minutes to see what's going on. You guys can watch the live stock market for. All right. Is this thing on? Sorry about that. Actually, was my new water cooler that they're delivering. So let me get back to questions. Sorry for the interruption. Barstool Sports. What is the best bear stock with the lowest expense ratio, and how do they charge for those? I don't know if you're talking about a leveraged ETF that goes in the opposite direction. And then down here, I was thinking SBDN. Let's take a look. All right, so that's a Direxion. I don't know if they pronounce it Direxion or Direction. One-time bears. So oddly enough, Yankees, we were chatting about this, a couple friends of mine, because when things started dipping yesterday, I was talking about the TQQQ, which would be the opposite. It would be a 3 times leverage play for QQQ. You're looking for bear, which when the market goes down, this goes up. I think I'm not in a position to advise you on it because I don't understand exactly how they charge for it. The one thing that we were discussing yesterday with my buddies was the concept of leveraged ETFs erode. Their value erodes over time. So holding them, let's just say for 2 years, during high volatility periods actually cuts into your gains. So be careful if you think, like, if you're watching COVID cases, right? This would be an interesting one to compare to COVID cases, since that's sort of come up this week. And, do you buy in when COVID cases are spiking? I could see that. And at $23 a share, I mean, what's the worst that could go wrong, right? You just have to do it with your risk, with a risk management approach. Like, how much money do I want to lose? Do I want to lose $1,000? If everything goes wrong, and then see what happens. But double check the period of holding. Some of these things reset every day. TQQQ resets every day. Some of these, though, only reset once a month. And there's a big difference in there, because if it only resets once a month, I think you erode more. So there's a lot of studying to be done. I wish I could give you super technical details, but that's as much as I know. Okay, going back up from there. Gigi, 1 second, guys. All right, sorry again. SCHD for Lion. Jump right into that. Dividend ETF from Schwab. I mean, right off the bat, you're probably in a pretty good spot here, just from a brand standpoint. So it's obviously went down a little bit, but the yield of 3.45 is obviously what you're in for. Frankly, I don't even need to see what this is holding. I'll do it anyway. But you got Home Depot, Exxon, Intel. I like it, right? I was actually not expecting it to have some of the growing companies in it, but having Home Depot, Intel, Pepsi, Texas Instrument, Verizon, those are all sort of growing companies. So from an ETF standpoint, a dividend ETF, I'd say in the first minute of looking at it, it looks pretty good. And that one for everybody was SCHD. All right. Let's see what Dylan says. You said the stock market is high, but a lot of stocks are lower than when it crashed 3 months ago. Would you still hold off on buying in on something like Boeing or Disney? No, but I guess my point, and it is, to be fair, it is sort of a philosophy more than a technical guidance, I guess you would say. So if you go here on Disney, and this exemplifies exactly what Dylan is saying, on February 20th, Disney was 140. Today, or yesterday or so, it dipped a little bit, and now we're sitting at 114, right? So lower than it was, which, Dylan's point is, why would you say the stock market is high? So Disney's in travel, leisure, whatever. And that is one asset class or category that is still trying to bounce back. The problem is revenues, right? So if we go to PE, this is Yahoo Finance statistics. Hopefully you guys can see that. And I'm sorting by quarterly. Trailing PE for Disney right now, according to Yahoo, is $55. You can see over the past several quarters that Disney's trailing PE was in the teens, and one time it hit the 20s. Forward PE is 41, right? You look back through time, much, much lower than that. And then PEG and price to sales, those are all up higher, and those are numbers that you wish would be lower. So the bottom line is, I don't think Disney is a bad buy here. For if you promise me that you're holding it for 5 years, you absolutely promise, then it's a no-brainer. But if any part of your strategy involves you selling it in less than 2 years, I would be concerned, because I think Disney parks, and go back to one of my Disney overview videos, Dylan. I think it's like 3 months ago. You'll see that the parks portion of Disney was roughly 40-ish to 50-ish% of their revenue. There's no way that parks gets near 100% revenue comp for, no, I would say a year and a half, right? So that the price of 142 with the PE that was offered back on February 20th, the revenue numbers have fallen more than the stock price has. Hopefully that makes sense. Now, you promised me you hold it for 5 years, and we assume that COVID goes away, parks have an opportunity to come back and get to 100% revenue. Then they have to grow revenue, which is a whole nother game. That's what you're dealing with. So I hope that helps. Baiju, what are your views on Lyft? Not interested, personally. I think Uber is the better play by a mile, but I liked Uber. I was interested in Uber. I was super interested in Uber when they were about to buy Grubhub. Now that has fallen through. Uber is cutting expenses, so a lot of their growth engine, so to speak, which I would have considered to be Uber Eats, which would have grown more with Grubhub, Uber Freight, which was taking, freight transportation to another level. That's been put on hold. Scooters, bikes are gone. I'm not in on them anymore. I'm glad I didn't buy, because I think they're destroying their growth. Certainly for this year. We'll see if they jump back in next year, but they got set back a little bit in all this. In anything to invest long for about a year that's not already run up beyond belief, that's kind of hard to say. I like the question, though, just for entertainment purposes. If you were going to say who runs up the most in a year, and I'm going to stick with things that are not mega risky, let me think about it for a second, because some of these have run up so high. I would look at, I like Google right now, especially since the price is falling a little bit. That would be one that I would consider. I like Visa a lot. I just talked about them. I don't think that their prices run up at the same level as some of these other stocks. I would say PayPal, but they've run up ridiculously. Tesla's run up. I'm not a huge Tesla fan, but that thing could do a lot in a year, but it's run up massively. So I don't know. For lack of preparation, I will say Google is, if you're going to say 12 months from today on June 12th, who's up big, I would say it would be them. That's without getting into micro stocks and pharmaceuticals and such that could turn on a dime. Yankees Rain, thank you, of course. Jeffrey Lundberg, what are your thoughts on UCO? Let's take a look. Ultra Bloomberg Crude Oil. I'm assuming this is leveraged. 2x the performance of crude. I'm not an oil guy, so hard for me to say. I will say that oil can't, I guess my 2 cents is I don't believe oil will stay at these crazy prices, so it's not the worst bet I've ever seen. I wouldn't put my money there because I don't know enough about oil, and I hate things that are controlled by governments. And So knowing that the price of crude oil is not necessarily 100% supply and demand, right? You have the other nations that are at play, controlling supply, taking back supply, all this crap. It scares me. However, if you're familiar with oil, you follow it every day, you've got a feel for what's going on. This thing has an opportunity. This 2X crude oil certainly has an opportunity to go up big. I would get on some sort of oil board or oil Twitter chat and see what guys are saying who do it every day. Lions, March 18th. Oh, that was Disney. Yeah, man. Disney under 100. Unbelievable. Disney under 100. That's what to do. Libby says sell Disney and buy in later. I'm thinking sell is interesting. Probably depends on when you bought it. Funny enough, if you bought at Lions $79 on the dip, I would probably just hold that because you're never going to see that again. I don't think you'll see under 100 with Disney again unless there's another dip. So to your point though, Libby, I would agree that you probably have time. So if you've made some money and you know that Disney isn't going to be rocking the revenues this year, I could see that. I really could, especially if you want to say you want to start getting into second waves of sickness, which would likely occur in the winter time or December or whatever. Then you're definitely, you and I are thinking alike. Okay, newbie. Thoughts on new IPO Zoom info? I recently bought in the 40s. Is that Zoom the conferencing thing? Always good. There's two Zooms. Okay, this is different. It's ZI, Zoom Info Technologies. He or she bought in the 40s, which looks like it was June 4th. It's now at 50. Operates cloud-based go-to-market intelligence platform for information and insights. Helps sales and marketing professionals identify target customers, decision makers, etc. I'm going to go to Tip Ranks. I don't know this. I've actually heard of this, but I don't know enough to say. And new IPOs are really hard for a guy like me who relies on fundamentals. No analysis yet. So at least in Tip Ranks, who covers like the big boys as far as analysts go, they've got nothing. It makes it even harder for a guy like me. Zoom info. Let's take a look at the company. If we can load here, hit your number, find and connect with your ideal customer. So it looks like a sales platform, right? And my first thought is, what does it do that LinkedIn doesn't? And that's going to be the big one for me. So in this tab actually locked up here. Oh, it wants to give me a free trial. That's why. So what does this do that LinkedIn doesn't? I'm sure it has a differentiating factor to it. However, if I was in enterprise sales and I'll just grab one here, sales, if this was me, Salesforce, Pardot, and I'm selling to the companies listed here, I could probably navigate LinkedIn, particularly a premium LinkedIn subscription, and get to most of these people. However, I'm going to guess Zoom Info has another way to do it. So I'm gonna say I'm not interested. At $40 and you're at 50 today. I don't know what to tell you on selling that. You know that there's going to be ongoing risk in the sales environment. with what's going on right now. So I would tread cautiously, and I would watch it every day, and whether or not I sold. That's my take. Oh, Lion, what would you rank these oil companies? I can't. I kind of alluded to that earlier. I can't because I'm not an oil fanatic. So I'm not going to lie to you and just make stuff up. Pratik, hello, Geoff. What's your take on Mastech Digital? Run a quick analysis. Okay. MHH. Going to switch to year to date. I'm going to go down here since I'm not familiar and do a little quick thing. Digital transformation IT services to large, medium-sized small businesses, data and analytics service, and IT staffing. So I think your data analytics IT staffing, that's a good place to be. Project-based consulting services, good place to be. Big data and analytics, all good places to be. Staffing services in the areas of data management, analytics, cloud, mobility, social automation. If they're doing what they say they're doing, great. This is a service that's in demand. Okay, IT staffing right now is ridiculous. It's expensive. It's time consuming. The retention rates are terrible. So if you can outsource project-based to bring on someone to serve analytics, cloud, mobility, automation, all that stuff, and they can deliver with good reviews, then I could totally, this is one that I could see doing very well. I also see the P ratio of 24, which looks somewhat promising, especially in today's world. And actually, over the past few quarters, it's run up a little bit. But I think it's worth looking into. Let's check on debt. Always a concern. Revenue was 200 million. Cash on hand is 2.5 million. Total debt is 26 million. Not terrible. Their revenue far outweighs their debt load. The cash on hand's a little low, but we don't know what's going on there. I'm going to guess that they are very slowly getting back into the game if they're providing staffing services. So, you know, not a bad pick, Pratik. I would dig deep, but on the surface, I kind of like it. Libby, good tip on ARKW. Just sold my shares. I don't like Tesla either. You and I are in the same boat. That I like ARK. I like Catherine Wood. I think that she's really smart and that she's looking ahead. But I didn't buy that ETF for Tesla and Square. So that's the number one reason I sold. I encourage everybody on the chat today to go dig into YouTube. Just search for Kathy Wood or Catherine Wood. You'll get a ton of videos. She was doing some like at home with Kathy Wood or something. I think it was every Friday during the crisis. And they were really good. They were very insightful. And it was just her talking about the current environment and what she saw. And so I encourage you to watch those. They're not long, maybe 20 minutes. And it's interesting to hear from somebody who's made money for investors to talk so candidly about what's going on in the world. I found it refreshing. Victor, what is your opinion on S&P 500? I'm not big on S&P 500. I am big on NASDAQ, particularly QQQ. So if you're going S&P 500, which would be like the SPY ETF, I encourage you to consider the QQQ, which is the NASDAQ top 100. And I encourage you to compare the results over the past 5 to 7 years. I think it's a much better play. Will it, you know, just to be fair, Victor, your question, can market go down again? Absolutely. Should it go down again? 100% yes. We'll have to see if that happens. Murdy with ATI. Is that Activision? Oh, no. Allegheny Technologies. Down a lot from February. P ratio of 5, good sign. Off over here, they've hit their earnings. These are just quick things I look at for companies that I don't know, right, off the top of my head. They're trending the right way in earnings, okay? 2016, they were not profitable, and now you're seeing some profits. You're also seeing some revenue growth. Good signs. Allegheny Technologies sell specialty materials and components worldwide. High performance metals and components, advanced alloys. We're getting into stuff that I don't know a lot about. Titanium, titanium-based alloys, nickel, cobalt. Sounds awesome. I don't know anything about it. So it's hard for me to tell you. This is what I would consider to be a technology-based industrial play. So not my specialty at all. And when you're talking about materials, you have this weird world with materials that, and one of the reasons I don't play here is that all these things, titanium, nickel, cobalt, powder alloys, shit like that, has a market of its own. So when you're selling things that do these, that use these components like titanium, the price of titanium changes every day. So your company that builds materials with titanium, their prices change every day. And so it's really going to be up to Allegheny to make sure that they have a ton of contracts booked. And then further, make sure that the price of titanium doesn't ruin their contracts, right? So if I promise to sell you a widget for $2 that's made of titanium, and I have a contract, and depending on the terms of the contract, if that's locked in, and titanium suddenly goes up to some stupid price, it could, if my company's poorly run, it could cost me $5 to sell that titanium part for $2. So that's a risk. Not saying that happens to Allegheny. I'm just saying that you're playing in a world that I'm not familiar with. However, Murdy, if you're familiar with it and you're good with the metals market, then this might be something. I like where the price sits today compared to a historical trend. So unfortunately, it's not something I'm super smart about. Lion, will you be adding NVIDIA? Saw your video. Yeah, NVIDIA is awesome. Will I buy NVIDIA as a standalone stock? Probably unlikely, only because I'm about to dump into QQQ, and they're a big part of that. Let me see if I can tell you for sure. So that's on some of these stocks that I cover. My core ETF positions include them. Let's see how big NVIDIA Holdings is in QQQ. They're 2.2%. Okay. So Microsoft is the highest. Microsoft and Apple and Amazon, that's 30% right there. Then you got your Facebook, Alphabet combines for 8%. But I love NVIDIA, and I would consider buying it. I do think it's super high right now at 350, if it's still doing the 350 thing. Just like I said in my video, I think you would love to get in under 3. This is year to date, February 19th, right before the crash, you're at 314. Some lucky guy or girl got it at the dip for 196, Lion. Now, if it's 196, man, you certainly have to consider it. The hard part is if this is at 196, we talked about Disney at 79. You have to know what you're going to buy on those days, right? But to be fair, whoever got it at that price is at 352 today. Too high for me. I think financial education, Jeremy, who, by the way, I don't know him at all personally, but I do enjoy his videos. He was talking about their valuation yesterday or the day before, and he showed this chart, the Yahoo stats, and it was 65, not dollars, 65 P ratio, trailing PE today. A year ago on 7/31/19, that figure was 31. So it's run up, right? Do you get it under 300? I don't know. I'm going to get by QQQ on the dip, and that's how I'm riding it. So hopefully that helps. No love for Elon. No problems with Elon, and he is an entertaining character. I don't understand why Tesla stocks $1,000. I don't. And you can talk about changing the world and all those things, and that's super awesome. For me, I just don't understand it. It's worth something. Absolutely. It's worth a lot. $1,000, probably too much for me. Walmart long-term, easy win. Make sure it's not Walmart, it's Waste Management. Doesn't change my projection though. I'm surprised this one hasn't bounced back more from February at 126. Now, prior to yesterday's dip, you got to 113. I'm guessing because so many things closed that their contracts got hurt, right? Whatever services they were providing, all those services were down. You'd have to get into the investor report, but Waste Management for the long haul, absolutely. Here's a 5-year. $46 on June of 15. You also get a dividend, don't you? Yep. 2.11%. This is one of those and here's a headline related to it. 3 great stocks for low risk investors. This is not only the obvious, right, which is trash, curbside trash, landfills, all that shit. This is also medical waste. This is recycling, which we know is a big deal. This is also recovery. So, and I guess that's kind of recycling, but when I say recovery, it's like taking steel out of the landfill and selling it to a steel recycler. So, great company as far as I know. I've never heard a bad thing about them. All right. I'm going to hide that. Oh, question. The good entry point of 100. I'm with you on that. I'm with you. If hopefully we would see something like yesterday on May 11th, it was 95. Could you get there again on the next dip? I don't know. Well, I'd tell you to watch the COVID news because yesterday we had a little COVID outbreak here in America, and that's supposedly what affected the markets. Maybe you can even get in lower. How do you view Hang Seng and Chinese marketing from the current level? So my take, just super quick on Chinese stocks. I used to own for a very short time KWeb. Love Chinese internet stocks theoretically. Hate what's going on with the US and China. Just don't like it. I think it makes everything too volatile for someone like me who lives in America and invests in American stock exchange to buy Chinese internet stocks. I wish I could. I'm just too scared that they'll disappear. So I will say that Chinese marketing, if that's kind of what you're getting into with internet things like Tencent, etc., I think there's a lot of promise for the future. I just wish the countries weren't so opposed to each other right now. It makes it very risky that some of these things will disappear. Libby again, are you waiting for the next crash? Correct, absolutely. Doubt I would buy today. The first thing on my list today, where are we at now today? Oh, we're starting to go down. I was wondering if this would happen, by the way. If you're buying something today, I recommend you wait till about 3 o'clock because the things have really been accelerating on the sell side after 3. So that's what I'm going to do. And Libby, I don't think I'm doing QQQ today, but I do have my eye on Visa. I was thinking about 190. We're already 188. If we can get another like pre-weekend sell-off, I'd feel pretty good. This isn't the cheapest that Visa could be. Back in the dip, what was it? 135, and in the May dip, we were at 177. I'd love to get under 180. I just don't know if it's going to happen, but I'm going to keep watching, see what happens today. I might buy a little Visa for the weekend. Just to finish the thought, QQQ, 235 or something today. I'll show you where I'd love to get it at. Want to look at that May dip again. May 13th at 219. So the love to have it price would be under 220 to start a position. And then knowing that there's uncertainty in the market, if you could get at 220 and buy the rest of the dips for the year 2020, which I'm assuming we're going to have a few more, I think you're in a rock solid fundamental position for the future. That does assume that you're holding for a while. What is your take on Hilton? Hilton is good. Hilton is still down from the pandemic. And let's see where we are today. Okay, 76 from 111, P ratio of 29. Hilton is well run. Let me double check my stats here. Trailing PE is in a relatively good place compared to where it was the past several quarters. Forward PE is obviously suffering. It's going to take a while to get back to full occupancy. Looking for debt. $10 billion in debt. They got $1.7 billion and in cash and $3.5 billion projected revenue over the past 12 months. So debt load is higher, to be expected considering what happened to the travel industry. I'm going to say wait for a day that you can't pass. This would be nice, right? 64.85 on May 13th. That wasn't that long ago. Okay, that was 30 days ago that we had a little dip. You're at 76 now. I think you're golden for the long term with Hilton. Absolutely golden. I would wait till you see it on a day that you're just like, today's the day. I know that today is the day. So hopefully that helps. Christopher, looking to increase my stake in Microsoft, hold out for 170s. Yeah, that sounds about right. I think I did some Microsoft one, and it was 182. I did a video. I think it was 182. Today we're at 185. Yesterday was a wild Microsoft day. 190. It hit 196, and then it dropped to 188 or 186 or something. We're down a little bit more today. If you already hold the position, I would use your cost basis as a guideline. So for example, I'm going to pretend for fun that you got in, you're running about 179, 180. You could be much lower than that, actually, the way this is going. 185. definitely sounds high. The 170s, depending on your cost basis, I think that's a fair target now that I start talking about it. So hopefully, Christopher, that helps. I definitely think you have an opportunity there to hold out, and I wouldn't be over anxious. Pratik's ready for my merchandise. Yeah. My goal is, to be fair, is in the neighborhood of 10,000 subscribers. So I have a lot of grinding left to do. When I get to 10,000 subscribers, I'm not so much into t-shirts and stuff. Maybe somebody can talk me into it, but I plan on doing some sort of group / newsletter where I give you basically all the interesting news and stuff that I read for the day, all the upcoming trends, all the stock, the stock movements that I've seen that are intriguing. So that's my take. It'll be low cost, super low cost. And that's, when we get closer, I'm going to ask you guys about it. I have to think about it some more, but that's where that game's going. All right. That's all the questions for right this second. I'm going to get a drink here. Excuse me. All right. So one of the things that was on my agenda for the day was to talk a little bit about what I think is another undervalued market. And that is real estate. And I'm not talking about buying houses, right? And I'm not actually talking about REITs either. You guys know that I'm kind of anxious about REITs right now. I just don't know where they're going. But start thinking to yourselves about real estate service type stocks. So fair, what's the word I'm looking for? Oh, sneak preview. I have Zillow coming out tomorrow. I just recorded it. I have to edit it and all that. I'm not saying Zillow is the greatest thing of all time. What I'm saying is real estate. In fact, Zillow is a bad example for what I'm about to say. Real estate related stocks, services tied to real estate are down right now. Okay, so think about mortgage providers outside of banks, specialty mortgage providers. Think about private mortgage insurance providers. Think about people who help with property management. Those groups are still down. And everything that I see in the housing market is positive, minus the fact that people don't want to, be in a room with 700 people. So I'm seeing real estate services as something that you may still be able to get in low on. I actually love Zillow. You'll get my full opinion on it on the video. But since I'll give you the too long didn't read, love Zillow. Huge opportunity over the next 3 to 5 years. It's going to take perfect execution. And I would probably not buy it at 55. I would wait and try to get it. I'm looking at this chart again. Man, 45 would be cool. And then with Zillow, the way I'm going to do it, because I'm going to buy it, I'm going to let's say I get at 45 and I'm guarantee holding it for 3 to 5 years. I'm going to buy all the dips, sort of old school Warren Buffett style, right? I know because it's real estate and because this is a stock with no profits right now, we know there's going to be dips. If you just look at their 1 year, you see this chart, even outside of COVID, right? Let's skip COVID for a second. So let's just go Feb 20 back to June 17th. There's all these lulls with Zillow because people can't figure out what they're trying to do and they're getting impatient on the profits. I feel like I don't know. I like their service and I like their model. Watch the video tomorrow for more in depth on that. But you can just keep adding down to Zillow. You can probably get your cost basis throughout the year, particularly if you're lucky enough to do this at $25. You can probably keep your cost basis around $40. And this stock in 3 to 5 years, if everything goes well, the real estate world is going to change. It's been begging for change for a long time. And I'm talking about residential, and I'm talking about, the old days of hand holding with your real estate agent and sitting in a car for 8 hours looking at different houses and talking with a separate guy about banking and all this other crap. Zillow is trying to bring that together. Now they still have to execute it. All right. And I can't help with that. I can only tell you that I've dug into the details and I like the concept. Execution is harder than conception. So we'll see what happens. But even if you don't like Zillow, take a look at Redfin. Much the same. Here in Ohio, Zillow is far and away more popular than Redfin. But it seems to me from watching the Meet Kevin channel, he talks about Redfin all the time. He's out in California. I'm guessing Redfin's bigger in California. I haven't even heard anyone who doesn't follow stocks talk about Redfin. That doesn't mean they suck. It just means that here in Ohio, it's all Zillow. So that's all I know. But anything in real estate, I think, is worth your time to investigate. One example, since these aren't the best, Radian Group is a mortgage servicing company. No promises here. I'm just alerting you to the fact that Radian Group is down. It's down $10. You look at this is 1 year on Radian. Here's 5 years. You got some ups and downs. Generally speaking, though, they are doing well. They provide private mortgage insurance. They provide some mortgage like credit checks, stuff like that. This P ratio is super low, but to be honest, this company runs on a super low PE it has for a long time. And let me see what else they do. Operate in 2 segments: mortgage insurance and services. Mortgage insurance, blah, 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 sort of speaks for itself. Then first lien loans. Where's the analytics? Transaction management services, loan review, mortgage-backed securities, securitization, distressed asset reviews, valuation services. They have a nice little service offering. And this, in my opinion, is a stock that is going to benefit from any increase in real estate transaction volume, right? So how many houses are sold? That is where a stock like this is going to do well. And I believe with mortgage rates the way they are, and even if you have foreclosures, you're going to have buyers for foreclosures. I can see Radian Group eking out a pretty good year. And it has a nice dividend today at 3.3%. So this one is on my list. And I'll tell you, if it does anything like this $10 back on the dip, if you're inching closer to $10, I think it's a free bet. I really do, especially for like $1,000, right? If it inches towards $10 and you put $1,000 in to get 100 shares, and you know that you're going to hold for a year, I think I feel pretty good about that one. So hopefully that helps. Libby has a good question. Sorry, I was staring at the other screen. So Zillow has, what they're trying to develop is multiple income streams. Right now, to answer your question directly, they make money off of their website traffic, their database of, it's like 100 million homes. So they run real estate agent ads. They also run certain offers for mortgage servicing companies, stuff like that. That's one way that they make money, is through advertising and media. Now, the bigger play, though, they're trying to get out of sort of the search engine business, right? The sort of like the only reason you have Zillow is to check on the price of your own house and look at your neighbors' houses. They are trying to get into end-to-end transactions, as well as what they call Zillow offers, where they're actually using their database to find undervalued properties and making offers directly to people. That is not profitable yet, and I cover that in my video, but it's the longer term play and it's the scale play that makes it interesting. So today, if you're buying Zillow today, don't buy it for the Zillow of today. Buy it for the Zillow. If you believe in their model, if you see opportunity over the next 5 years, my video will help you with that. If you believe in that, then you'll see that there's quite a bit of opportunity. Okay, Lion Jerome Powell's speech. I really like that guy, actually. I think I like him more because he gets thrown under the bus and he just gets hammered by Trump. And I sort of appreciate the fact that he just stands up there and he is him, right? And it doesn't matter what other people think. That's just kind of resonates with me. But beyond those things, I will say that Powell, I'm surprised of the direction that he's taken. I'm surprised that he hasn't let the free market sort itself out a little bit more. However, when he says things, I generally believe him. Okay, so when he says that he does not have an extraordinary concern about a recession, he does not have extraordinary concern about economic collapse, I actually believe him. And he seems to think, and he actually says, that what he's doing today with his team is working. And in the stock market, it certainly is, right? I guess for the long term, I wish he wouldn't have said interest rates are zero until 2022, because it takes some of the play out of negotiation, right? Like if we got stronger as an economy, he sort of threw that chip out early, man. You didn't have to go that early. You didn't have to say 2022. I wish you would have said certainly through this year, mortgage rates would be zero. However, he expanded it to 2022, and now everybody's going to hold him for that. And even if we don't need it, that's where it's going to be. But so that's my 2 cents on Jerome. He deserves more credit than he gets, in my opinion. And I think he's trying to run the Fed in a professional, data-influenced way in an almost impossible time when everybody has an opinion, and perhaps even more impossible is the president's expectation of your position. And all those things considered, if it was a voting situation, I would vote for him. Vera's PK. I don't know that one. Park Hotels. So you're in travel, so you know right off the bat what the risks are. And just to be 100% clear, I don't care if you're Marriott, Hyatt, or Park Hotels, you are staring at best, probably 75% capacity across the year. So earnings are going to be a problem. The PE ratio right now is NA, not good, which should be NG. Park is the second largest publicly traded lodging REIT with diverse portfolio of market-leading hotels, resorts, and significant underlying real estate value. Park's portfolio consists of 60 premium branded hotels and resorts with over 33,000 rooms, primarily located in prime city center and resort locations. Forward dividend and yield of 20% is intriguing. With that dividend and this price, regardless of what I say, I don't think it's super risky. I would worry that dividend is going to go away, or at least be cut. So please don't get it for that. And with the price movement that I'm seeing since March 18th, I think you probably still have more time if you're super interested in it. And along those same lines, I think you got a while before it gets to $20. So that's me looking at it from a high level, just for fun. Let's see their website. Portfolio. These are all America. I was kind of curious if they were some international. New York Hilton. So that one, geez, they were probably at 0% capacity. San Francisco, potentially the same. I'm going to guess that Hawaii wasn't hit as bad. I have no data on that. I put it this way. If I was super scared of COVID, but I absolutely had to go on vacation, I would certainly consider Hawaii because it's away from, the rest of this world that's so closely packed together. New Orleans hit pretty hard. Chicago hit pretty hard. Orlando has reopened. I don't know if this, hotel is reopened, but Orlando is reopening. Another Orlando, San Francisco hit pretty hard. San Diego, no idea. Seattle, that was the epicenter of COVID. Buena Vista, the same thing as Orlando. Puerto Rico, no idea. So anyway, I think, to their benefit, they've got some monster properties that are almost destinations in themselves. Try to go through their investor relations information, assume a 50% plus drop off from last year's revenue if everything goes back to normal, and assume worse from there if it doesn't. And then, hey, can you hang in there? Can you get your dividend and call it a day? And then hope that you wake up in 3 years? And if so, man, it's probably not a bad game. But there is risk. Morningstar Farms versus Beyond Meat. Sure. You get a drink. So the alternative meat game is one that I don't think this is what you wanted. Morningstar Farms. I'm not seeing it. MORN. Oh, and this was it. I don't think this is Morningstar, research services. So this isn't Morningstar Farms. But I will tell you about Beyond Meat. I think that Beyond Meat is, darn it. I think that Beyond Meat has something going for them. I think that it's much smaller than people assume. However, the world is changing, and I think the market for their products is growing. At the end of the day, though, the thing that most people miss on Beyond Meat is right here. Revenue trailing 12 months, $350 million. Okay. That's good for us if we're running a lemonade stand, right? That's not good for a company whose market cap is $8.3 billion, whose market cap rose $4 billion since 3/31/2020. So for that reason, I'm out. Going forward, however, assuming they can scale and save money on production, and I would also argue that they are going to need to improve the nutritional value of their products because they are skewed to taste right now. And with that includes a lot of things that vegetarians are not going to like, such as fat, salt, sugar, and etc. That's where they need to go. I saw them once on Mad Money, the CEO, and he called those things out, which is super encouraging. Beyond Meat, in my opinion, doesn't have a lot of run left this year based on all those things I said. 5 years from now, knowing that the world is changing and the people's tastes and preferences are changing, I don't think it's a bad bet. But it's not a shoe-in winner. I feel like a lot of people put it in that basket of easy win. I don't see that myself. Is SCHG close to QQQ? Perhaps. Everybody has their own little spin on it. So this is Schwab's large cap growth ETF. Let's take a look at their holdings. Guessing you use a Schwab account, so you probably get a discount or something on trading these, which is absolutely understandable. So here's your differences, right? You got Microsoft, Apple, and Amazon are probably, Facebook, Alphabet, those are probably all similar. What you're missing here is NVIDIA. You're also missing Pepsi. Let's try to stack them up. Let's remember this. Microsoft, Apple, Berkshire. I don't think Berkshire is in QQQ. I would be surprised if United Health is either, and Home Depot won't be. Not apples to apples, I think, is what we're going to end up to answer your question, but doesn't mean it's bad. Intel, NVIDIA, Cisco, Adobe. So it really starts to change after the top, call it 40%, 35, 40%. Doesn't mean it's bad, right? Doesn't mean it's bad. The NASDAQ has certain requirements, and I don't know enough about it to tell you, but it does have some growth and technology requirements to be listed there. Pepsi is not represented on this list, but Pepsi is in the QQQ. We're only doing the top 10 holdings. Let me see if I can get to QQQ holdings in quickly without boring us all. Fact sheet. See, everything that's like a little fact sheet just has like the top 10. Somewhere on this website, though, they do have the holdings. Alphabet, Tesla, Intuitive, eBay, sector allocations. Just list. I don't know why it's so hard to just list it. Darn. You can, obviously you can do it yourself. I don't even know if this is, oh, I found it. I have to put it in the screen that I'm sharing though. All right, here we go. Percentage of, I'm not going to group by sector. I'm going to group by percentage of fund. Apple, Microsoft, we know all those. Then you get into under 3%, Intel, NVIDIA, Adobe, Netflix, Cisco, PayPal, Tesla, Comcast, Pepsi, Costco, Amgen. So there's some differences. They're subtle, but they're there. And it's actually the differences that we just sort of highlighted are the exact reasons. Those are the sort of like percentage plays that I like to have with QQQ. So for example, I just went on about Tesla. I'm glad that QQQ has 1.84% Tesla. And if Tesla despite my bearish sentiment, if Tesla does grow much more, this is market cap adjusted, so Tesla will rise up the ranks, and but it will do it in a market cap appropriated manner. So I don't have to worry about a fund manager loving Tesla when I don't and just putting Tesla at the top of the list. That's what happened to me in ARK W. So hopefully that helps. Vera, PK versus Hilton. I personally would go Hilton. It does look like PK had less debt than Hilton, but I'm just going to tell you that from my seat, Hilton is a strong brand in my opinion, and they cater more towards higher middle class to luxury segment, which means that a lot of people in that segment are less likely to have been impacted by COVID when it comes to vacations. So that's my pick. Try to get both of them minus 10% if you can. Just for no other reason than you should not be buying much of anything when the stock market is all-time highs. S&P, it's dropped 0.08%. We're getting close to 3 o'clock. Does that mean that my 3 o'clock prediction will come into play? Perhaps. That would be nice. Just kind of eyeballing some things. Visa's staying under 190, so there's a chance I buy that. Okay, so I've covered everything that I wanted to cover with you guys today. I'm going to hang out for 2 more minutes to get any last minute questions. Thanks to everybody. Tomorrow is the Zillow video. I'm going to edit that after I get off here, and sort of normal week. I'll book a live stream for next week. It probably won't be on Friday because I got some other things going on, but my goal is to do these mostly on Fridays. So I hope that you can join, and I'm glad for everybody who has come back and for everybody who's joining for the first time. Last call for questions. I don't know how to refresh my questions. So anyway, keep your eyes open. If we don't have any more questions, keep your eyes open for 3 to 4 p.m. Eastern time for a possible market dip before the weekend. No guarantees. It just seems to me that there's been some sell-offs lately around that time. Maybe you can save a couple bucks if you're planning to buy something today. So thanks, guys. Really appreciate your support with the channel, and I will see you on the next one. Have a good day.